Welcome back. Now I will talk about value drivers, which refers to revenue growth and return on invested capital and cash flows. Because end of the day, when we do evaluation, we want to focus on future discounted cash flows. So we somehow have to relate the cash flows to your profitability and revenue growth. So how to do this in this particular case? So we have done our NOPLAT, so we know the money we make from the business, so that's an important aspect. But how do we get from NOPLAT to the cash flows that we can use to distribute to shareholders and debt holders? Yeah. So again, the focus in our case is on the so-called free cash flows. So this is not only the money that goes to the equity holders, this would be equity cash flows. This is money available for all people that need basically money. So here we talk about the debt holders that get their contractual payment, the interest payment, and repayment of principal at maturity or over the lifetime of the debt, depending on our contracts, and the equity holders, our shareholders. So we don't look at the distribution of the cash flows. That doesn't create value. We look at what's the total pot of money we generate from our operations. Sometimes this is also called the PISA theory of corporate finance. So we look at the total size of a pie or pizza, whatever you want to eat, and we don't consider how you slice it up. Or put differently, whether I pay this money as a dividend or not, that doesn't affect the size of it, doesn't affect the value. So that's the main idea behind this. So we don't look at distributional effects, we look at the total size of your value that you can generate from running your business. Now, what do we have to consider when we talk about these free cash flows? So first of all, we have to keep the business going. So that's quite fundamental. So certainly, if assets depreciate in value, for instance, the machinery needs some replacement, that needs to be considered. So if you want to maintain our invested capital, depreciation is definitely something which we have to consider. The other aspect, of course, is when you start growing your business and your revenue goes up, it's quite likely that you also might need more invested capital to keep running this business. So for instance, you might need to increase your production capacity to serve more customers. So put differently, we have to look at depreciation and a change in invested capital. Yeah. So if you expand your business, it's very likely that you need more of it. So end of the day, that needs to be considered. Now, when it comes to depreciation is already captured in our operating expenses. So our NOPLAT should consider this in our calculation. And then we have to look at the invested capital we calculate, and we determine the change of invested capital, which gives me the additional money required to run the business. And this would be covered under capital expenditures or CapEx. So our formula for deriving the free cash flows refers to our NOPLAT minus a change in invested capital. So these are the main aspects. So when it comes to understanding the process of increasing your cash flows, we have to understand basically two things. Yeah? We have to know how is your invested capital changing, and we have to know how is your NOPLAT changing. And these aspects can be captured in two value drivers. One is growth, yeah, so increasing the size of your business, yeah, which might maybe also require, of course, more investment. So there's a downside to it. And the other one is profitability. Yeah, so that's an important aspect. So in terms of understanding value, the key question to ask is, well, how much more do I need to sustain that growth? Yeah, so that's an important aspect. So in this particular case, we can consider measures such as the reinvestment rate. So how much more do you need to keep running your current business? So the reinvestment rate is defined as the change in invested capital relative to the money you make from the business, your NOPLAT. And growth, of course, is a combination of your reinvestment rate requirement and your profitability. Yes, if you look at the profitability measure, ROIC is NOPLAT divided by invested capital. So if you then simply cut out the NOPLAT in this equation, you end up with the change in invested capital relative to the invested capital, which gives you a measure of growth. So basically you can decompose growth into your profitability measure times your reinvestment rate. Yeah, so these are the components of it. Yeah, so that's the important issue. And of course, we have to make certain assumptions here. So one assumption we make here is that the capital turnover, which is another useful measure for asset utilization, so revenue relative to invested capital is constant. Yeah. Again, we could of course split this further if we analyze this in a business case. So there are other ways to look at cash flows as well. So I just derived some further relationships, but they are just following on from our definitions of the reinvestment rate. But basically your free cash flows are your NOPLAT minus the change in invested capital. So I can also express this in terms of a reinvestment rate. So if you have a very high reinvestment rate, it actually cuts down your free cash flows because it means you have to invest a lot to grow. And that can be a useful metric. Yeah, so what we do here basically is we just express the free cash flows in slightly different ways to get a different interpretation of these ratios, which can be helpful. Yeah, so that can be useful, and you see actually how we have done that. So put differently, growing the business has some complex effects, because partly, of course, you increase your revenue, which is good, which should drive your NOPLAT, but also you might need to reinvest, and so it depends on which one is the dominant force. So put differently, growth is not always a guarantee for value. It does not always translate in the same impact on free cash flows what you would expect if reinvestment rates are very high, for instance. So I think these are now the main insights which we can summarize. So we spoke about all these aspects. We focused on how to obtain NOPLAT as the money you make from operations and invested capital, the money you need to run the business, and then we derived the cash flows, and we related the cash flows to metrics which we define as profitability measures and revenue growth. And we saw that revenue growth has a complex relationship. We have to make sure that our reinvestment need is not too substantial, because that limits the impact it has on free cash flows.